Hello, welcome on board FM Financial Management. I'm Rashaad Hussain, your expert tutor for FM. Here with the topic explainer on cash flow forecast. Let's begin with a story on Starbucks. Back in 2008, during the financial crisis, Starbucks faced a major cash flow challenge. They were expanding too quickly, and with falling sales, they had to make very tough decision. By closing underperforming stores and carefully budgeting their cash, they not only survived the downturn but came back stronger. This shows that sometimes focusing on cash flow management can save a company and set it up for future growth. This example from Starbucks highlights how important it is to draft a proper cash flow forecast by identifying potential cash shortages, cash surpluses. Business can plan ahead and make right decision to stay on track even in difficult times. This topic of ours deals with the syllabus area C2F cash flow forecast. A cash flow forecast tool estimates inflows and outflows over a specific period of time. It's going to help a business predict cash shortages, cash surplus, enabling them to plan future expenses and investment more efficiently. So, what is cash flow forecast? It's a detailed forecast of both inflows and outflows, and please note it incorporates both the revenue and capital item. Now, if we look into the cash flow forecast format, what all do we have? We have got all the receipts and then we have got all the payments. From the receipts, we are going to reduce all the payments to get what? Net surplus or deficit, to which we are going to add the opening balance to get the closing balance. What are the various estimated receipts from our receivables, from cash sales, when we sell the non-current asset, disposal of non-current asset, receipt from issue of shares or debt. Totaling all this is going to give us total cash receipts. Then we've got the estimated cash payments, a lot of payments to make to the material, the labor, the overheads, the dividend, the non-current asset, and repayments. Finally, all of these totaling, giving us the total cash payments. Total receipt minus payment is going to give me either a surplus or deficit for that particular month, from which I'm going to add opening balance in order to get the closing balance. Let us try cash flow forecast with an example. Here we are with tech company problem on cash flow forecast requiring to calculate cash flow forecast from Jan to March. This question contains the sales units. The notes includes details on selling price, raw material price, variable overheads, opening cash balance, dividend, interest payments, long-term loans, machine purchase, and finally the requirement is to calculate the cash balance at the end of each month during the 3-month period. You are highly recommended to pause the video here, go try solving this question, and then get back to compare your answers. Now, loading the problem on the constructed response workspace and pre-filling the requirements of the question, and then let's solve it. Getting the things pre-filled. Here we have it pre-filled, and let's start solving. Tech company is developing a cash flow forecast for the 3 months spanning from January to March. The following period sales volume have been established. Sales units are given for, even though it is required to be, the cash flow forecast is required to be found out for Jan, Feb, March, December onwards till April is given. Now let us use these information given here, scrolling all the way down. This working note is not necessary to be done. It is only for us to understand easier. We've been provided the sales volume for December is 500, for January it is 1000, for Feb it is 2000, for March it is 3000, and for April it is 4000. The selling price per unit is $700, 700. So let's mark it all 700 and again 700. What does the question says? With a 5 percentage increase for January into 5 percentage increase for January, all the sales are on with a 5, with only one single increase is there, which means that that increase 735 is stands for the next 2 months, both for March and April. All the sales are made on 1 month credit. So what I sell on December, I'm going to get its money on Jan. So let me mark the sales values with this. Sales going down, picking the sales, multiplying it with the selling price. Whatever I sell in December, I get it in January. And like this, whatever I sell in Jan, I get its money in Feb. And what is sold in Feb, the money is received in March. Now, the collection from sales for Jan is 350,000, for Feb it is 700,000, and for March it is 1,470,000. Moving on to the next point, production for sales occur 1 month prior to the sales month. Sales is provided, so whatever is supposed to be sold on Jan month will be produced in December. Whatever is supposed to be sold on Feb will be produced in Jan. Whatever is supposed to be sold on March will be produced on Feb, and whatever is supposed to be sold for April is produced in March. The next point, each unit produced requires a raw material priced at $100 per unit. There is no inventory of raw material and purchases are on 1 month credit. So the purchase is not going to be based on sales, it is going to be based on production. So what material is used for production in December? This 1000 units that is used for production on December, its raw material payment shall be made in Jan. Jan production units, its raw material is being paid in Feb, and Feb production units, its raw material is being paid in March. So in December, 1000 units we have, that 1000 units into 100 will give us the payment to the supplier. So given equal to, select this 1000 units into 100 gives us 100,000. Next one for Feb, picking up the Jan production units 2000 into 100. For March, picking up the Feb 3000 units into 100, which gives us all the payment to the suppliers. Variable overheads and wages amounting to 50 per unit are incurred during production and are paid in the month of production itself. So the same month of production, 2000 units into 50 is paid as variable overhead. The for Feb, 3000 units into 50 is paid in Feb itself. And for March, 4000 units into 50 is paid in March itself. And these are the cash flows for variable overhead and wages. The next point, the anticipated opening cash balance on 1st Jan is 60,000. 60,000 being marked here as opening balance. A dividend of 50,000 will be paid in the end of January. A dividend of 50,000 being paid at the end of Jan is not going to be Feb, whether at the beginning or the end of a period. Unlike the cash flows in investment appraisal, here if it is a particular month, whether the beginning of the month or the end of the month, it is considered in that same particular month. So here it is going to be adjusted at Jan, the cash flow is going to happen at Jan, and that amount is going to be 50,000, the dividend payment. The company must make an interest payment of 9,000 in the beginning of Feb, which is going to be for Feb, which is going to be 9,000 for Feb. A long-term loan of 200,000 will be received at the start of March, so it's going to be received a long-term loan, and the amount is 200,000. And the next point, a machine costing 800,000 will be purchased for cash in March. So March, there's a machine purchase which is 800,000. Now we've got all the receipts, all the payments. The receipt minus payment is supposed to give me a surplus or deficit for all the 3 months we've got for Jan, Feb, March, which is 100,000, 341,000, 370,000. To the surplus or deficit, when I add opening balance, I'm supposed to get the closing balance. 1 month closing balance will be next month opening balance. And again, the surplus or deficit plus opening balance will give me the closing balance of the Feb month, which is 501,000. This 501,000 will become the opening balance for March month. And the March closing balance is going to be the surplus or deficit plus the opening balance, which turns out to be 871,000. Now we've drafted the cash flow forecast for the period from Jan, Feb, March, which has got all the receipts. We have totaled the receipts. We have the payments. We have total all the payments. From the receipts, we have minus the payment to get a surplus or deficit. To that surplus or deficit, we have added the opening balance to get the closing balance. And for the purpose of understanding, we've got the sales units marked, the sales price marked, and also the production, which is happening 1 month in advance. And this is our cash flow forecast for the period Jan to March for the tech company. Now let's see how this cash flow forecast is used. The cash closing balance for Jan is 160,000, for Feb it is 501,000, for March it is 871,000. There is no deficit at all. It is all case of surplus. This much excess surplus closing balance is not required. The tech company can plan whether there's no deficit at all, so it can plan that there are surplus. So how the surplus has to be utilized, whether it is going to be utilized for expansion, or whether it will be utilized for other investment purpose, or whether it will be used for paying higher dividend to the shareholders. So this closing balance is going to help the company plan ahead the resources. For more question, you may refer the Study Hub 11.2.3. Try out activity 3. Well, that's all for now. Signing off, your FM expert tutor Rashaad Hussain. Thank you.